Welcome to Markets.com. You're watching a company profile on United Parcel Service, better known as UPS. Founded in 1907, UPS is a package delivery company that provides transportation, logistics, and financial services worldwide. It operates under three segments: U.S. domestic package, international package, and supply chain and freight. The company's headquarters are located in Atlanta, Georgia, with Scott Davis as the CEO. UPS is listed on the New York Stock Exchange and traded on the Dow and S&P indexes. UPS's vision for growth is split up into different categories. The first way UPS can grow is by taking market share from other express players. Right now, UPS holds 36% of the domestic express shipments. That is a far second to competitor FedEx, which holds 49% of the same market. There is possibility for it to capture market share as its prices for express are usually lower than FedEx's. And a key reason why UPS wants to capture market share is in this key market is that the margins are higher than its core business of ground shipping. As the rest of the world emerges, it is critical that UPS captures more market share worldwide, and they are doing so by expanding their capacity in both Europe and Asia, as worldwide GDP is growing at almost double the rate of the US. Another way that UPS envisions growing is through developing a supply chain solutions business. Recently, they purchased two companies in this space but have had trouble integrating them into their business model. The plan UPS has is to bundle services like freight and logistics for major companies. Also, part of their plan is to maintain their market share in their core ground service operations domestically. UPS is very careful about guarding their 54% market share in the U.S. ground business and believes that a few innovations might help it increase that number. Still, this is a highly cyclical company, the reason being that most of the revenues come from its domestic packaging business, and this business depends on the growth of the U.S. economy as package shipments depends on business and consumer activity. At the moment, the U.S. economy is in a recession and manufacturers are slowing down production, so decreasing product volume is expected. Another factor hurting the company is slowing consumer demand, which has online retailers suffering. The less these retailers have to ship individual packages, the more UPS's margins will decrease. On the other hand, oil prices have been going down, which will lower shipping expenses, therefore lowering the company's expenses. Also, with competitor DHL just ceding its market share to its competitors, there will be increases in market share by both UPS and FedEx. The verdict: the economic crisis should bring trouble to some of UPS's smaller competitors, and UPS will have to wait for the economy to turn around before we see any positive moves in their stock price. That's our company profile on UPS. I'm Luisana Suegar. Thanks for tuning in.